if you've looked at your 401k lately, then you know the first 3 months of this year have been really good. As a matter of fact, some of the most widely held mutual funds are up more than 15% this year alone, which is good, but it's also a reason to think about what's next. Can we continue on this trend? Joining us here is Joe Bert from Certified Financial Group. Joe, good to see you as always.
Good to be here, Joe.
All right, these funds we were talking about, some are up 21, 22% in the first 3 months, which makes me think, all right, they're not going to be up 80% this year. Do you stay? Do you move some money around right now?
Well, for sure, they're not going to be up 80%, but it's a question of your timing. You know, particularly a guy like you that has time, you're aggressively invested, and it's actually bad news when the market continues to go up, because as we said in the past, the name of the game over your working lifetime is to get shares, and as the prices go up every month, you're feeling good about your account, you're buying fewer and fewer shares. If I could design the ideal portfolio or situation for you, John, what we want to do is see prices go down, continue to go down over your working lifetime, because you're buying a bunch of shares, and just before you retire, they spike up. You'll be a gazillionaire.
So this is good news for people who are maybe getting closer to retirement right now, recovering some of those losses they've had.
Exactly, John. But what you don't want to do is time the market, which is what most people try to do. You know, we let emotions get involved. We're human beings. We think we know what's going on. We jump in and jump out. If you're well diversified and you have your plan in place, stick with it.
Joe, I saw something the other day that said the most people who got out of the market during this recent downturn got out at the very bottom. They did exactly what you preach you never do. They sold when it was at the bottom.
That's correct. In any bull market, so let's say over a 10-year period, if you're out of the market for the 10 best days of the bull market, you've lost 80 to 90% of the gains, and nobody knows when those days are coming. Yesterday may have been one of those days.
Okay, Bernanke spoke yesterday. Why did his comments, or why is that creating so much positivity for the markets?
Well, the word of the day yesterday was accommodative. In fact, if you play words with friends, that's worth about 200 points. But it was accommodative, and what he's saying is we're going to keep interest rates low for as long as we need to. And people, today you can't put your money in a CD and get 1/4% or 0.5%, or lend it to the government at 2.5% for 10 years and try to get by. You've got to put it in equities that are going to give you some rates of return, perhaps some growth, some dividends of 3 to 4%, and that's where the money's going.
I guess maybe one of the most important things here is with these stocks going up like this, companies now have a little bit more cash. They've been sitting on cash. Do you think it loosens up the job market now to where they will hire more people?
Well, companies aren't going to hire until we get through this political season. You know, we've got a lot of things overhanging us, what taxes are going to do, what the medical situation is going to be. So companies are very, very cautious, and what they're looking is trying to get the most out of the workers that can, and hiring temporary workers and trying to get technology to work for them.
All right, Joe Bert, the Oracle of Orlando. As always, great to see you. We'll talk to you soon.
John.